All right.
I'm just going to hit mute on my end.
Okay. So the very first thing that I would like to do today is I'd like to go over with you an asset that was recently purchased. And we have now gone through the full cycle of buying an REO, or what literally is known as a non-performing asset. We have converted that non-performing asset to a performing asset. In the process, we triggered a profit event of that asset, and we currently are receiving a cash flow as a result of the sale of that asset. So this asset here, it represents, in essence, what we want every asset in a portfolio to represent. We bought it as a non-performing, we converted it as a performing, we continue to see the benefits of that conversion process. In this case, the very first thing I want to show you, because I'm going to go through a series of, images, if you would. I'm going to show you the actual HUD-1 that we received when we purchased the asset. Now, if you're familiar with a HUD-1, this is a document you would provide to your CPA at the end of the year if you had sold a piece of property and needed him or her to include the data on your tax return. In this case, it shows the combined purchase price CMI paid to purchase a total of 3 assets. So on the top left-hand corner where you see the red circle, there's a total of 3 assets listed on there. And of course, they're identified by property address. These properties were purchased from a private equity firm, and CMI paid a total of $75,000 for 3 properties. And you can see the $75,000 listed towards the center circle of the page, right above it on line 101, contract sales price $75,000. Now, if you divide the closing costs, which is that center red circle, $2,148.50. If you divide that by 3, that means that each property had closing costs of $716.17. And then, of course, the other red circle to the top right of the page of that image, it shows on there when this purchase was made. This purchase was made January the 31st, 2018. So on here, the next slide or the next image will show you some of the details concerning the sale of that property. So we bought it January the 31st, 2018. And now I'll use my mouse as a cursor. Now you can see here the settlement date is February the 21st, 2018. What that obviously means is that we sold that property approximately 3 weeks right after it was originally purchased. I'm having a difficult time keeping a zoom on this, but you'll see on there the contract sales prices. This property here, 3302 South Perry Street, Montgomery, Alabama. It was sold for $59,000 on February the 21st, 2018. Now on here, the CMI extended a note to the buyer in the amount of $54,000. So you can see on line 202, principal amount of new loan, $54,000. That's a seller finance note that we extended to the buyer. And then last but not least, you can see down towards the bottom of this, I'll see if I can get comfortable with the zooming, but if you see down towards the bottom of this, the very last circle there, it says at the close of escrow, or when the transaction closed, the seller, CMI in this case, received almost $4,000, $3,998.78. So what that obviously suggests is that the buyer came in with a down payment between $59,000 and $54,000. So the buyer gave a $5,000 down payment, and that's just shy of 10%. But when the $1,000 in closing costs were subtracted from that, we received the difference, almost $4,000, and you see that represented at that bottom circle. The very next slide on here. The very next slide on here, it shows what the second page of that HUD-1 looks like. Now, typically, and I think you would know this, but typically when you sell real estate, you pay a commission if you are hiring a real estate agent. The standard commissions nationwide are typically about 6%. So in this case, if we had paid the 6% commission for a sales price of $59,000, we would have paid approximately $3,540. That bottom circle you see there, it shows the commission of $750 that we actually paid to sell this property, which 750 divided into the $59,000, it represents approximately 1.25%. This here clearly demonstrates the power of the network we have established and how that network allows us to take advantage of money-saving benefits we receive in return. It's just something that I like to point out because it's not often that we actually address things that we will address in this presentation. The very next image that you're looking at there is a mortgage. It's the first page of a mortgage that we use when we extend a note or a seller finance arrangement to a buyer. So on here you can see at the very top I've circled the first mortgage. We don't have any underlying loans on this property, so it is a mortgage in first position. It has on there the date that the document was drawn by the attorney. It has on there the dollar amount, $54,000, and then most importantly it has on there the date that this seller finance arrangement fully matures. Every mortgage is accompanied by the actual debt instrument known as a promissory note. So the very next image you'll see on there is the promissory note. Now the promissory note in this case, you'll see that we've circled just three key pieces of information. One is the loan amount, $54,000. You can see on there we're listed as a lender, Conde Millward Investments LLC, an Idaho limited liability company. The interest rate that we charged on here, which I did not circle, I easily could have, but it's 10%. Once again, this circle here shows when this note fully matures. It matures February the 15th, 2028. And then, of course, the amount of the monthly payment, $713.61. So when we prepare these notes, we obviously have to conduct due diligence on the preparation of these documents. In some cases, we have attorneys that work with us to prepare this. Some of these instruments, they're prepared in-house. It just depends on the arrangement that we are using. So the very next image that we see is an amortization schedule. And on here, if all we do is we plug in the pertinent numbers, which is a $54,000 loan amount, 10% interest rate that we are charging, and for 10 years or 120 months, this will give us a payment of $713.61. So obviously what this does is it suggests that over the next 10 years, by the buyer paying us this monthly payment, they will completely pay off the $54,000. After we run this item here, the amortization schedule, the very next item that we run in-house, and this is probably what you're going to like the most, is we run a yield assessment of every asset. To us, the most important barometer of an asset is the yield. And it's the yield because it demonstrates the strength or a weakness in that investment. We share 50% of our profits with money partners, so whenever we're running these yield assessments, we're obviously looking for ways to maximize the yield on an asset. Now, in order to determine the yield on an asset, we have to engineer a calculation based on different data. So the very first thing that we will do is we will use the cash flow, $713.61, payment over an extended period of time, in this case over 10 years. But we here, instead of using the $54,000 in order to determine our yield, we now have to determine our acquisition cost or basis in this investment. So in this case, I think on a previous image I showed you we purchased this property for $25,000. We had closing costs when the asset was initially acquired of $716.17. The buyer paid a down payment of $5,000. So he purchased the property for $59,000. We financed $54,000. The difference, $5,000, is what the buyer paid as far as a down payment. When we sold the property, we had closing costs of $1,001.22. So when you subtract and add those items to the initial purchase price acquisition cost of $25,000, you see the amount that we use to calculate our annual yield on this investment. And that is the amount that you see here, the $21,717.39. That includes or encompasses all of the money we have invested into this asset, and it factors in the $5,000 down payment from the buyer. Here's what's most striking and important about this is that 38.543% is the yield that we will receive over the next 10 years. And that, by the way, is an annual yield we'll receive over the next 10 years on this investment. The most interesting thing about this is that 39% per year for 10 years. This is a type of asset any money partner would welcome in his or her portfolio. I mean, this is about as good as it gets. I think it's fascinating. On this asset, you could easily say we swung for the fences and we crushed it out of the ballpark. I mean, there's just, it's hard to argue against the results of this asset here. Now, the very next slide is now what we use to determine exit strategies. So let's just pretend a money partner has had this asset in his or her portfolio for the last 10 months. So this asset has now successfully paid for 10 months. So initially it started out with 120 months. It now currently has remaining 110 months. So we have received 10 monthly payments of $713.61. So at this point, let's pretend that the money partner has to decide, do I stay with the partnership program, possibly extend it another 2 or 3 years? Or at this point, do I look to exit from that partnership program? So let's pretend at this juncture that the money partner has opted to exit out of our partnership program. What we do here is we demonstrate now when we go to sell that asset, typically what's the amount of money we can get from the sale of that asset. In this case, we have two things that are working against us. Number one is we have less than 1 year seasoning on a paying asset. It's still, by definition, it would still be classified or categorized as a sub-performing asset. What that generally means is we're not going to be able to obtain a high premium price in the secondary and private markets. The markets are just not there when it comes to sub-performing assets. Once performing, it's quite possible that we can yield a higher price for the sale of this asset. But right now we have that working against us. So we have the less than 1 year working against us. The other thing that we have working against us is we purchased this property for $25,000, and literally in less than 1 month, we resold it for more than twice its price. We sold it for $59,000. So there's a seasoning issue at work there. Most private or in the private and secondary markets, most investors that look at this will not give a premium price on it because they view it as still on the higher risk side. They look at this and say, okay, so you've successfully collected 10 payments on it, but you still sold this asset for more than twice what you paid for it. Truth be told, in the secondary and the private markets, most of these investors would probably offer us 50% of the $59,000. So the amount that is circled on this image, $29,500, is the actual amount that we would possibly sell this asset for in the secondary and the private markets 10 months after the property was sold. The unfortunate thing about it is that it now begins to give a different side to the exit strategy. Had the money partner allowed this asset to remain as part of his or her portfolio, you recall that there was an almost 39% annual yield available. If the money partner at this point decides to liquidate the asset, we would sell it for $29,500. If we bought it for $25,000, we would literally receive a gain of about $4,500 minus the fees and the costs that were paid. And in our partnership program, where the money partner receives 50% of the profits, you can see that this, what in essence was a very exciting asset to have in a portfolio, now becomes something that gives possibly a mediocre, result. The interesting thing about exit strategies, when you compare them to the actual investment strategy, the exit strategies sometimes do not make a whole lot of sense. It's hard to fathom that an asset with so much potential can be sold with, at such a steep discounted price. But in the secondary and the private markets, they have all of these factors, if you would, requirements in place to prevent them from absorbing, losses along the way. The very next item, as you can see, it shows on here, the property was sold for $59,000. This is an online valuation. This is what you would see on your computer screen if you went on to Zillow.com, Zillow, Zillow.com, and you did an online search of this property. So here's the address to the property, 3302 South Perry Street, Montgomery, Alabama. And as you can see on here, 3-bedroom, 2-bath, 1,730 square feet. To be able to sell that for $59,000, I think it says something of the market. To be able to purchase it for such a low price of $25,000 and literally sell it 3 weeks later without doing anything to the property, I think it shows you the power of some of what we do in our partnership program. This right here is the very last slide that I had on here, but as you can see now from this, you can kind of see, the investment strategy versus the exit strategy at play. I'll allow you to ask any questions, and we can revisit some of these images as you have questions concerning these items. Our commitment to locating high yield investments like the one that was presented on this conference call remains our number one goal, beyond a shadow of a doubt. Obviously I would welcome any questions you might have on the sample that was used to provide a demonstration of the enormous potential these types of assets can offer you as a money partner as you look to build and grow your portfolio. One of the other things, though, that I had in mind is to go over a couple of things concerning some of our quarterly statements. So what I did is I put together a fictitious quarterly statement. Some of these numbers may not, always add up. I had my assistant put together some numbers for me, and I really did not double check it. I think most of this will add up, but I'm not 100% certain that is going to be the case. But there were two things that were recently added to our, there was one thing or a couple of things that were added to our new quarterly statements, but I think that both of them are worth at least addressing on this conference call. The very first item is on page 2 towards the bottom. You'll see that there were a total of 3 new lines added. The one down here towards the bottom, cash flow 2017, that's literally where we want to list whatever cash flow we received when let's say on payments that were made during 2017. So on this very first asset, R012, you can see that there's some profits that are listed on here, and that generally involves the selling of a piece of property, and the profit would be the amount of monies we received after closing costs were paid. And this is, of course, from the down payment that was paid by the buyer. So here we see cash flow 2017, and we see cash flow 2018. These are all different lines that were added to our new quarterly statement. Down below, you see a total. Now that total there, 5509.84, it represents in this case a total between the profits and the cash flows 2017 and cash flow 2018. So one of the things that we wanted to do with our quarterly report is we wanted to show you as a money partner what this asset, beyond the profit profit event that was triggered when the asset was sold, what has it produced, or what does it continue to produce as far as the cash flow is concerned. We'll do this for all of the performing assets, whether it is an REO or listed as a PA, performing asset, SP, sold property. You can see that all of these here, it is used to track all of the cash that all of the cash flow that we have received on a property. Now, the one thing about page 1 is that we don't carry that information over here, at least not yet. We're hoping that we can change that, but one of the things that I wanted to point out, I have done so on numerous occasions, but maybe have not emphasized it enough. When a person looks at page 1 of their quarterly statement, they see total remaining capital. Now, the total remaining capital, generally speaking, it is the difference between the amount of capital that individual money partner contributed, less the acquisition costs on all assets that have been purchased. So in here you can see John Doe contributed $525,000 to our partnership program. We purchased 12 non-performing assets, and those 12 assets were purchased for $200,110. He has an additional 8 performing assets, and those assets were purchased for $133,110. When you add this $200,000 plus $133,000 and subtract it from the $525,000, it would give you the difference of $191,780. One of the things that this does not do is it does not add in the cash flow nor the profits. So once again, we're hoping to include that in the future, but for right now, it does not add those cash flows and profits in. Most importantly, one of the other things it does not do is it does not factor in any expenses. If you remember on page 2 of this, down at the bottom, we have cash listed, cash flow for the last 2 years and any profits. We don't have expenses listed. If we were to include the expenses, in essence, what we now would be providing would be a profit and loss quarterly report, and we would do that 4 times a year to all of our money partners. I think it would create a problem if we wanted to provide all of that data on a quarterly basis and in a timely manner. As it is, sometimes we go past our deadlines. I feel really bad about that whenever it does happen. But if we were to start factoring in expenses, we feel that that would really complicate things. So one of the things that I want to do is I want to just simply remind all of our money partners that when you look at this total remaining capital, it does not always represent unemployed capital that literally is just sitting in the bank not doing anything. I have money partners that feel that that's the case, and that's far from it. So one of the things that this here does not include is it does not include any additional cash flows and profits we have received, and it also does not include any expenses that we have paid on any of these assets on behalf of the money partner. Hopefully that information on how to read a quarterly report has been helpful. This portion of it concludes the presentation for our first quarter partnership program conference call review. Once again, I welcome any questions you might have. Please call us direct or send us an email if you would like to participate either in a one-on-one conference call to review your quarterly statement in greater detail, or if you have any general questions that you would like addressed. I thank you so much for listening.